Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Hi, everyone. I hope you are really enjoying the content I've been bringing and the longer in-depth discussions. Barry Allen, Raffi Tamazian, and today I'm bringing you Joel Kulina. He is the head of tech and media trading over at Wedbush Securities. Very timely, I think, just given the major sell-off we saw in the tech space yesterday, down by over 3.5%, essentially, but finding a nice rebound today in some areas. So we kind of took a look at, in our conversation, the causes for the sell-off, which we kind of know, the rising rate environment spooking some investors. But at the same time, we really wanted to delve into those secular themes that have been emerging in the tech space, and we think will continue over the next number of years. So we touched upon a couple of key areas. In fact, actually, we did a lot of areas and also got to some of your questions. So I hope you enjoy. We covered a lot of ground. Let me know what you think. Please subscribe and tell your friends to subscribe if you think it's worth it. And send me a message at contact C3M of things that you want me to bring to you. I've gotten a lot of your responses so far, and I'm going to continue to try to provide the value add. And now for my interview with Joel, please enjoy.
Right. Joel, great to be able to, continue to bring your views, your thoughts, and everything you know about tech to our viewers. Obviously head of tech and media trading over at Wedbush Securities. So a lot going on, certainly over the past week. It feels, people have been it seems a little bit nervous in terms of stepping into tech. But I think we really, saw it obviously in full swing yesterday. NASDAQ down by over 3%, rising bond yields. But today, last I looked, we did have the NASDAQ in positive territory. So maybe just give us your thoughts in terms of what took place over the past 2 days.
Yeah, it's been a wild start to the year when you really think about it. You look at the GameStop, the peak of Reddit frenzy was about a month ago, almost to the day. And that's kind of, so that the past month has been a very difficult, just really in terms of some of the aggressive, rotation that we've seen under the hood, driven by the rise in rates. Obviously I think, a lot of the hedge fund community has gotten a lot more trying to stay nimble in terms of their portfolio positioning, because you don't want to be caught on the wrong side of a trade that could really go pear-shaped quickly. But I mean, the overall theme that keeps on coming back to me in my discussions with clients is still being overweight tech still remains, the favorite trade at the moment. That's probably been the case for the past 5 years. And the main reason for that is, simply put, with the Fed and global central banks remaining extremely accommodative in terms of policy and interest rates. It kind of just is going to continue to fuel the growth trade over longer term. Now, what we've been seeing this week, especially and really since November 9th, when we first got those Pfizer vaccine headlines, you are clearly seeing a rotation to kind of the value pockets of the market. So how long that this kind of rotation lasts is a little bit of a mystery. I think that still has legs. But at the end of the day, tech remains, still, you want to be overweight in your portfolio on a longer term horizon. Near term, I'd be more neutral to underweight. But I mean, when I say neutral, I mean 1 to 2 quarters. But looking out, the tech landscape is only going to continue to evolve. And we are still in the early innings of the digital transformation that's just been pulled forward by, years because of the global pandemic.
Yeah, and we'll talk about some of the themes surrounding, what's been pulled forward and the various stocks that play nicely into that. But before we get there, Joel, because I think that, people, when they see a big sell-off like yesterday down 3.5%, give us a sense in terms of what you saw. Like, was there a lot of volume? Was there a lot of activity? Was it real long-only funds that were in crowded positions, crowded trades, or was it algorithmic trading? What was it?
Yeah, it's been a combo. I mean, that's been some of the interesting stuff that I've read over the past month. It seems like increasingly when you look under the hood and you talk to some guys, some of the bigger firms in mind that have, program trading desks and option desks as well. Increasingly retail has become a bigger part of this market. There's days where 40 to 50% of the total volume is coming from the retail side of things, which is it's pretty crazy when you think about it, given that was 10 to 15% just a year ago. So this dynamic of the market's not going to change though. I mean, I think that's one thing, we're always going to have some sort of hybrid work from home type of, it seems like type of living. And clearly this has brought a lot more market participants, a lot more participants to the market rather. So it's going to remain. But in terms of in my world, yeah, I mean, like the past couple of days, there's some big drawdowns, and we saw some real de-risking. There never really a sense of panic. But if you look at the semiconductors, there were some quality names down 10 to 15%. Nobody really knew, wasn't it because of change in fundamentals, just more due to crowded positioning. And that's kind of what it's been hurting tech in the near term. It is, like I said, it's still an overweight trade. Guys are long the same names. So when you do get those drawdown days, like we had a couple, this yesterday, it's just, pain kind of, times two.
Yeah. And Joel, this is something that we talk a lot about in terms of why the market's down. And, everybody in the media says it's because the U.S. 10-year yield pushed through that 1.5% level. That puts downward pressure on perhaps some of the multiples in the market. And those are often so associated with the growth names, the higher multiple stocks that is. So, but describe a little bit further why, and I hear you, from a longer term perspective, there are so many aspects of technology that you do want to have exposure to, but from a near-term perspective, as people get concerned about inflation and perhaps even the overheating of the economy, you see a lot of selling pressure. But connect the dots for us why that would even take place.
Yeah, I mean, there's that's a good question. I mean, it's I think within technology, the one group of stocks where valuations have gotten extremely out of whack. We're mostly in the high growth software and cloud verticals. And I think even the past year, some of the big high profile, IPOs that hit, I mean, you have stocks opening up and they're already trading at, 30 to 40 times sales, if not even more, whether it was, DoorDash, Airbnb, Unity, a software company called AI. Some of these eye-popping valuations were just, insane to say the least. And I think that's where the move in the rates and especially the 10-year, it's kind of reset valuations and finally, valuations only matter until they do. And I think that's what we've been seeing the past few weeks in really the past month in tech is that now guys aren't really willing to pay up. Growth at any price gap, that trade's not working anymore. And that's why I still think you want to find the winners within the sector that are still going to benefit from secular trends that are just a little bit more reasonable price. So like the semiconductors, they benefit from a steepening yield curve. They benefit from global GDP expanding and a cyclical bid out there as well as kind of robust demand from multiple end markets, whether it's data center, automotive, industrial, electric vehicles, AI, handsets, the 5G handset, really are going to lift off in 2021 as well. And then, move over to the digital, social media, internet names. Look at Twitter yesterday, their analyst day, they're talking up their revenue rate over the long term was just fantastic. And they're talking up new product and monetization kind of initiatives. You saw a couple days prior in Snapchat, their first ever analyst day, they came out with just some huge numbers. So those are kind of names I still think there's a lot more runway for growth. And you look at a name like Facebook, some of the, I'm just not a fan of Facebook here. So I think you want to look for names that are, okay, Facebook's going to struggle from the regulatory overhang, increasing concerns over how they handle people's data and privacy issues. You want to look towards, second tier names within that kind of vertical, and who's going to benefit from investors, money coming out of Facebook. It's going to be the guys owning Snap, Pins, and Twitter. So things like that are kind of what we're seeing, just really a shift within tech, which has been kind of fantastic to see.
Mm-hmm. And Joel, just in terms of what we're actually seeing today, before we get into some of those more company-specific stories and those themes to play, what are we seeing? I mentioned yesterday when I did my market recap that we'll see what today looks like, if it'll be a buy on the dip scenario, which is really what's worked since the financial crisis, and that appears to be what we're seeing. Now, it might be tenuous, and I don't know what the volumes are looking like at this moment, but what's going on today?
Well, you just hit the nail on the head. Volumes. The volumes aren't there, and that has been the case. Almost every rally we've seen, especially this week, where we get these dead cat bounces, it's been on no volume. I just looked at, NASDAQ volumes down 37% versus the 20-day average for this time of the day. We'll see if that should pick up, into the last kind of couple hours of trading, given month end. So we'll see how that plays out. But that's been the trend, is that volume. The big volume days have been on the down days. And you are seeing rallies being sold versus a dip spot, and that's kind of what's been the mentality that I've seen in at least in my seat over the past. But again, today you look at the solar names are back at the top of the leaderboard. Semi-equipment names kind of were at the bottom yesterday, at the top today. But like I kind of said yesterday, talking to a lot of guys, it just seems like February trading has been, the key has been staying nimble, not getting, not being caught off sides in a position that's gone, could get, ugly pretty quickly. And so hence it's been a very choppy month, to say the least. But it's been a good month for, January was a tough month for the hedge fund community. So, guys have seen a big recovery in their P&Ls over the past kind of 4 weeks or so. We'll see what March brings, but there's definitely a lot of nerves. The Reddit army is real. And all-star fund managers have to pay attention to it, because you don't want to doors to close because of a company like GameStop, which again, as we all know, it's gone parabolic the past few days, and it's a dying business that's going to generate $1 in EPS max, and right now it's trading, well over $100 again. So that's 100 multiple in a dying business in a strip mall.
Wow! And so explain that. Like what's been driving that?
Yeah, it is. It's been there's a lot of funkiness under the hood, is the way I kind of sum it up. So it's obviously, I don't know if it's coordinated, but there's clearly a lot of people on social media platforms that have gotten together, and they're also involved in really, far outdated option activity, which creates, creates gamma and option dealers forcing to cover some of their positions to hedge. So there's a lot of elements going on with some of these Reddit names, which it's complicated. None of it really makes sense. And clearly anyone who's buying it up here, it's essentially a Ponzi scheme, because all you're hoping for is that someone's willing to buy it higher than you, because fundamentals don't really support anything what we're seeing in a wide range of stocks. And I know we talked about ARK Investment Fund, and that's where the rise of Cathie Wood and ARK Investment is something to keep an eye on in the coming months. That's kind of what I've been paying most attention to lately, because if I don't know if it's a bubble. It's keep an eye on though.
and just describe what that means though, Joel, in terms of why her funds matter or what's been going on there.
Yeah, so in fairness to her, she's been a voice, a fresh change for a lot of investors, especially younger investors. She's been bullish on emerging technologies, whether it's been crypto, EV. She's been very early in some of her calls. A lot of the work from home plays she's been big in, like Zoom Media, DocuSign, those type of names as well. But now that her inflows, they rose sixfold in 2020. So she has to put that money to work. And I think becoming a victim of your own success, she's had to kind of ratchet up her risk scale a little bit. I think something I read, 43% of her funds are in very illiquid smaller cap stocks. Which again, if the tide turns, things can get out of control very quickly. I think she has over 13 positions with over 13% holding in all of those. And I think the issue because of ETF status, you have to be very transparent. So the market is fully aware almost on a daily of what she's doing. Like we knew she added to her Tesla position earlier in the week, Bitcoin, she doubled up on Workhorse, a name that that was trading at a ridiculous valuation because of expectations on a big postal service deal. Well, they lost it, and the stock fell 50 to 60%. So she doubled up there. Stock had a big squeeze yesterday on some noise from a member of Congress, but now it's rolling back over today. So that's kind of where the risk can lie, is that the holdings in her ETFs are just they're known to the world.
Wow.
So people can't just front run these positions ahead of expected redemptions, and you could see the momentum snowball effect going the other way. So it's something to keep an eye on.
Yeah, and it's interesting that the dynamic that you just described is something that I think that, retail individual investors, family offices are like, wait, what's going on? Because that's not what I know about, looking at a Coca-Cola and trying to figure out how many bottles they're going to sell and Doritos or whatever their snack food is, and then having an earnings per share number. They're different dynamics, and that's why you can see some of these wild swings that, not everybody loves to walk through or go through. But Joel, why don't we talk then about some of the big cap stocks, those go-to names that have been such the winners over the past number of years, and then we'll kind of get into a little bit more of the ones that you think are really interesting right now. Amazon and Apple, those stocks have been weak as of late. What's going on there from an institutional perspective?
Yeah, I mean, me and you have talked about Apple, I feel, probably for 4 years now. And every time you get this sort of pullback, I think we've had about a 15% pullback. I could be off a little bit. It's a buying opportunity. I mean, Apple, I think, starts at the top with Tim Cook, but, obviously, the 5G handset sales have been ahead of expectations. Now, JP Morgan had a negative note out yesterday, so that kind of weighed on Apple and some of their supply chain members. But, we think they're being overly, conservative, and we really don't believe their numbers. But Apple, clearly their iPhone's still the best product in the market. Their accessory business is becoming a bigger piece of the pie with AirPods success, and then the services just kind of remains the gravy train, which continues to grow, albeit at a slower pace. But we're still seeing mid-teens growth for a huge growing asset, and they're still slowly but surely making some making their way in the streaming with Apple TV. But the story is still driven by the iPhone and what they're doing with the services, and then some of the smaller and we'll see what they do on the EV front as well. That's obviously something that's gained a lot more attention. But I think you can't bet against Tim Cook and Apple for what they're doing, saying going to EV. They've done it. They're moving very slowly. People have speculated about the quote unquote iCar, whatever you want to call it, for probably 5+ years now, and there's still really nothing concrete. So we think they're going to go down the partnership path, whether it's with a Kia, Hyundai, one of those type of OEMs is yet to be seen. But clearly they're playing their options. They're taking their time. They're not going to rush anything. And again, given their track record of just flawless execution, it's an impossible company to bet against. So we are seeing dip buyers of Apple, and then Amazon, similar story. I mean, they're still when it comes to the cloud wars, they're the king of the hill. And Microsoft is clearly been gaining some share of late, and Google's a distant third. But again, they've with cloud, what they're doing on the e-commerce front, as well as some of their other businesses, they're buy and hold type of stories. You can actively trade them, but it's tough to get too bearish on those type of names.
Yeah. So Apple and Amazon, you'd be a holder of. What's interesting as well, of course, is Google seemed to be so under-owned and unloved by the institutional community going back, I don't know, maybe 5 months ago, and then it started to get a little bit of a pickup. Where do investors stand on that stock now?
Yeah, I mean, Alphabet's my number one pick in large cap, in the large cap, kind of FANG complex. It's been that way for a few months now, and I think that's what you want to stay with for sure. And for a few reasons you said, it's been one of the more underweight name, under the radar type of names within that complex. And you clearly have YouTube continues to grow at a furious clip. And more importantly, last quarter, we finally are going to get more visibility and metrics regarding their cloud growth. This is the first time they ever broke it out. And so that eventually and to me, that signals to the market that this is where they're focused on. They think that business warrants a higher multiple. And that's just part of the system of the sum of the parts, valuation case, is that the portion of the business deserves a lot higher multiple. And it's gonna and they're gonna make a big push to gain share from Microsoft and Amazon. They don't have to gain a ton of share, but they can become a much more meaningful player in that battle. And then last part of the story, digital ad recovery has been phenomenal. And they're kind of obviously, search businesses is still the best out there. So for me, Alphabet, cleaner positioning, the YouTube component, digital ad recovery, and then obviously the more visibility metrics for the cloud unit. I think it's a story you want to get behind, and it has underperformed going back, 5-10 years versus some of these other large cap growth names. And I think that's where kind of a name you want to keep adding into the momentum to the upside.
It's amazing that these big bellwethers within tech, the Amazon, Apple, and Googles of the world, sound like they are still the secular stories and the leaders in their position that you want to continue to own. I mean, because even when you see these stock prices move, you kind of always sit there and think, should I sell, or do I buy now? Yep. It sounds like you don't sell. I mean, trim if that's what you like to do, but stay long.
Yeah, I think. It's I know it seems like a very lazy way of investing, but I mean, that's kind of what's been working. And obviously with COVID's kind of, led to the big rotation in tech last year for obvious reasons. And now as that narrative shifts to, vaccine optimism and reopening and hopefully a return to normalcy by the end of the summer, depending on where you live, we've seen this big rotation of value. But with end of the day, we've heard it multiple times from Jay Powell this week. The Fed is going to remain extremely accommodative. So until that narrative changes, you have to stick with the winners to some degree. But like I said, I mean, I do think this value trade probably has a little bit more legs. But I would not want to just blow out of my Apple or Amazon position because you think tech is dead, because that's just the wrong way to go about it.
Got it. And when we think about all the stimulus being put into the global economy, you mentioned at the top basically saying that, semis are going to be a beneficiary of that. Talk to us a little bit about, what some of the names are that we should be looking at there. And also, of course, Biden signing an executive order, really kind of looking at the semi shortage. I don't know what we're going to accomplish from it, but it seems as though maybe we'll have more made in America plants.
Yeah, I mean, and it could save Intel, which is obviously have had a rough go of late as well. But yeah, so I think I think the headlines first hit last week. Really was, I think, on the same day where it came out, and then Joe Biden finally signed it in an executive order this week, where the U.S. is going to try to figure out how to address the global supply shortages and reduce the supply chain risk. The European Union said the exact same thing. And no real shocker. I mean, obviously Taiwan Semi and Samsung are probably the world's two of the world, and as well as United Micro and Global Foundries are the world's leading kind of manufacturers out there. But it's clear, the global chain with, again, the rise in EVs and the increasing investment in artificial intelligence and 5G infrastructure that continues to be built out, and increasing chip complexity, that the world needs more capacity. So we'll see how this works out. It's going to take years, but you have to start somewhere. Mm-hmm. Clearly, that's what you have to realize. So, I mean, are you going to get an executive order this week? It may means we have a couple big manufacturing facilities, a decade out. But currently in the U.S., only I think only 12% of global semi chips are manufactured in the U.S. So, maybe you can get that up to 25% over a 10-year period. I mean, I'm throwing that out there, but I know Taiwan Semis, they're building a new fab in Arizona. Samsung has a facility in Texas. Maybe they do a big expansion to that as well. So for that, I think you want to be exposed to the semi equipment stocks. So it's the big ones are Applied Materials, ASML, which is really the winner for the continued shift to leading edge. And Lam Research, LRCX is the ticker for that one. And they're more levered to the memory side of things, which continues to recover. But again, that's kind of the easy, I call them the arms dealers of all this, of the global secular trends that are really showing no signs of slowing. So again, very simple stories. You don't have to overthink it. But we do know that, if you're going to have the US, the EU, China continues to ramp up production as well, they're going to build fabs. They need to buy the gear from some people, and it's going to be these select players that are going to benefit.
And where do we stand then on a company like Nvidia? I mean, they had great numbers, and yet the stock was down by 8% yesterday.
Yeah, I've been off the Nvidia train for a while. And more or less, I've kind of always I prefer AMD more because I mean, obviously AMD, they compete in the same markets to some degree, but AMD really continues to benefit from Intel's woes, on the manufacturing side, and AMD just continues to gain market share. Their new product cycles continue to gain traction. But so in terms of Nvidia, the problem with Nvidia right now, it was a big focus on their conference call the other night, is that they do have exposure to crypto. and management really didn't want to talk about it, rightfully so. But it's never a good thing when your stock becomes a little bit of a proxy for Bitcoin, given the volatility. A lot of seasoned investors don't want to deal with it. And so we'll see how that plays out. But that's kind of and also, sorry for Nvidia, they kind of, it sounds like their data center growth is slowing a little bit. Gaming's the bread and butter for them. They've, over 50% of the business comes from the gaming end market. But again, they warned of data center kind of just slowing a little bit. You throw in the crypto kind of overhang. Is this a story you want to deal with right now? Probably not. So
okay.
You get a move like that. I don't think you need to buy that anytime soon. I think there's other names in the semi space could go after.
Okay. It's interesting though, with respect to Nvidia and their exposure to crypto. Can you just describe that a little bit further?
Yeah, so essentially it's just like, like anything, like high-end gamers need these, higher end GPU gaming chips. Crypto miners, they need the same type of high-end chips to kind of to keep their facilities going as well, and that's what miners are looking for. And so it's that simple. So GPUs are also using cryptocurrencies as well as gaming, and it just, Nvidia's chips are the GPU of choice for that crowd. So that's really the extent of it for them. But it was funny. Their CEO Jensen, he really didn't want to. He kind of downplayed it significantly. He says he doesn't see it being a material part of the business moving forward, and I think rightfully so.
When we think about some of the social media stocks, of course, Facebook, another big bellwether, comes to mind, but there's so many other ones as well that kind of play into that same area, whether it's Pinterest or Snap or what have you, Etsy. These are some of the higher flying stocks as of late, or the ones that really, kind of appeal to certain people who obviously use their product. What's the outlook for some of those stocks right now, or the interest?
Yeah, I mean, I think I touched on it earlier. Facebook has been a major source of frustration for a lot of people. It's been dead money, I want to say, since early August, maybe early September. I could be off there. I'm talking the stock has done absolutely nothing. And then, and the recent earnings report was pretty lackluster. Daily active and monthly active users in North America are stalling and just, stalling to declining. You have the regulatory stuff, their recent battle down in Australia. Apparently they've been accused of inflating some of their audience numbers as well. It's typical, right? With Zuckerberg, it seems like these issues come up every now and then. But boom, just like what we've been seeing the past, few weeks from Twitter, Snapchat, and Pinterest. You don't have to own them all, but I'd own a combination of them all to reduce your risk somewhat. But there's some interesting things in terms of just new products coming out. They're really giving more clarity and visibility in their monetization efforts and how they see the company moving forward with these newer products. And then you just touched on e-commerce. I mean, God, like I think I highly suggest anyone just kind of skim through, Etsy's conference call last night. And I think what makes us here so bullish on e-commerce overall, it's, COVID obviously has accelerated trends, but I think consumers, it's just become engraved in people's behavior, like it never was before. And that's, people aren't going to revert to wanting to, there are always going to be people who want to go to a mall, walk around for a couple hours, go through that whole dog and pony show. But I think there's going to be a good chunk of the consumers out there. Why do I need to spend 2 hours going to a mall, walking around, when I can just go on Etsy or go on Wayfair? They all have great customer service, services as well. Get what you need, and you can spend that time with family, friends, do anything but be inside. And hence you'll see you'll see e-commerce become a much bigger piece of the pie, and these guys will gain a lot more share in the years ahead.
So that's definitely one theme that you're gonna, you believe will stay with us. Want to get to cybersecurity as well, and then we'll get to a couple of the questions. Cybersecurity, key theme. We've talked about cybersecurity though, Joel, for so many years. Give us the update in terms of how these stocks have really performed, and who's really leading the charge here.
Yeah, it's been the company that jumps out to me is Zscaler. The ticker ZS for those guys, and they're pretty much just cloud security. And the stock was up about 5% last I checked. They reported last night. Talk about probably one of the best CEOs in the entire industry. And what he was really saying is like, in terms of the shift to the cloud, digital transformations, the work from home kind of hybrid model, he's just saying kind of said it's here to stay. We're never going to revert to the way things were. I mean, it's kind of nice when you have people say like older people like myself who have families, like never again are you going to be forced to go downtown, 5 days a week. There's always going to be a remote and a hybrid model, meaning but you're going to need still elevated security because of that. But now looking down the chain, mid-December, you had the big SolarWinds attack, impacted 100 plus companies, multiple government agencies in the US, extremely sophisticated attack that was in motion for months. And seems like we keep on getting out new details as well. And I think that's a risk. I mean, security has always been one of those things, see a breach happens, people say we got to be better, we're going to spend more on security, then people kind of get lazy and can say, well, it hasn't happened to us, we don't need to spend there. That's why I think the hybrid working environment and the shift to cloud, the accelerated shift to cloud, digital transformations is kind of we're probably still in the mid innings of this trade. So I prefer some of the smaller caps in the space. I mentioned Zscaler on the cloud security side of things. SailPoint's another one, the ticker SAIL, SAIL. They reported great numbers, really strong guidance last night as well. They do identity management. And TELUS, tickers TLS in the US on that one, they have over 90% exposure to government, the US government, and that's what you want. And Joe Biden, he made it pretty clear that security is going to be a big focus of their plans, at least when they roll out their early spending plans. Security is a big chunk of it. So again, I think this is a portion of your portfolio you have to have some exposure to security.
Wow.
Just look around you. The connected auto, the more connected home, work from home, and again, just the overall shift to the cloud. It's people are doing a lot more on connected devices. So
yeah,
it's not going away.
Yeah, it's amazing. I mean, you're obviously in your home office and you're, running a trading desk, and the setup that I now have in my home studio is, I'm so connected. I have so many different computers, PCs, laptops, everything. I always want to unplug everything because I think everything's recording piece. So there's a lot of tech going on right here, and I don't own enough of those stocks. Joel, just two more items that I want to let you get back to the trading desk, but we talked about a lot of stocks that you like. Is there any other stock that you should mention that you also think is a really great one to know and own?
Let's see here. You look at the recovery play, right? We've obviously here in Canada, you've seen the big rotation, long overdue rotation back into energy. Financials continue to act well, materials, but within TMT, if you want a pure play on a return to normalcy, I think this year, at least 2021, we're not going to see a rush of business travel to some degree. That's probably still a year away. But I look at Lyft. It's a U.S. pure play on rideshare recovery.
Oh.
And why I say that, stock, it obviously recovered in the second half of 2020, but massively underperformed Uber for rightful reasons, right? Rightful reasons. Uber has the Eats component, which kind of saved it during during COVID. But Uber also has a lot more global exposure. They recently had a negative ruling in the UK a couple of weeks ago. I think earlier this week, the Chinese Dai, they announced plans to expand further into Europe, Western Europe as well. That's a big part of business for Uber. And I think just Uber has a lot less hair to the story. They're going to start doing
Uber or Lyft?
Oh, sorry, Lyft. Sorry, Lyft.
Okay.
Yeah. I expect I love that as a pair trade. Give me long Lyft, short Uber any day of the week for the next 2 to 3 quarters. And don't forget, Uber's also going to be facing a lot more serious comps on the Eats side of the business, in Q2, Q3, which a stock is going to have to deal with. And I think Lyft is just going to be the path to profitability is just a lot cleaner in the near. So Lyft's a name there. And then, a name like Airbnb, a winner from more domestic localized travel. People, they're going to gain share from people just looking at, less traditional accommodations. And that's been whether it's going to the beach, the lake house, whatever it may be. Airbnb is clearly gaining share, from the hotels, and I kind of prefer that name over some of the others.
Okay. And Joel, let me just take a couple of questions. I think we've done enough that we need to do on AMD and Nvidia, et cetera. That question was coming from David. There's one though, with respect to, hold on here, 5G. We talked a little bit about that. Best play for 5G, is it Qualcomm or Broadcom?
It's a good question. I mean, on my computer here. I actually prefer Marvell.
Marvell?
Marvell's a little bit better positioned and their cloud infrastructure in a 5G place, so a little bit more of a. I think it's the problem with Qualcomm which has been a great recovery story, but they do have a lot of exposure to China as well. And there is some talks about Apple kind of building out their own modem. So there's some potential headline risk with Qualcomm there, if Apple was to kind of bring their modem business in-house. Broadcom's become just pretty much just a steady Eddie type of stock. It's become extremely diversified over the past 5-10 years. Hock Tan, their CEO, really just went on an M&A tear for a streak there. So my favorite 5G play right now is Marvell. But I probably prefer Qualcomm. Probably prefer Qualcomm over Broadcom though.
Okay.
We are going to get a huge a huge lift in 5G handsets in 2021, which Qualcomm does have more exposure to.
Got it. Alternative energy, EV, best play there?
Oof, good question. I think I'm a little bit. You look at Kathy Wood's ARK ETF family, and there's a lot of those type of names in that umbrella. So I mean, I'm a little bit more cautious on that side of things. An EV.
Okay.
Yeah, I mean, I like to see look at the poster child for momentum. I mean, to me, like Tesla continues to make lower highs. It doesn't act well. I think some of the air is going to come out of these EV stocks, at least in the near term. So I'm a little bit more hesitant on chasing some of these. It's kind of like look at like a name like Workhorse yesterday, gapped up 20%, back down 18% today. If you can stomach that type of volatility, you're better than me. But I think if you're talking longer term, I think it's little bit too much volatile for my liking.
Okay. And lastly, you and I talk about Disney and Netflix a lot. We haven't yet today. So just real quick here, a question from Thomas. Does he see Disney becoming a tech stock as the company and others focus more on streaming and competing against Netflix? I mean, that's been a bit of a headwind for Netflix, potentially that theme coming out. But what do you say?
Oh, I love Disney. I think I talked with you about it months ago. Absolutely love Disney. I mean, their direct to consumer strategy. They had the analyst day in mid-December. I want to say, forget what day it was exactly. The recent earnings. I mean, they are just firing on all cylinders in terms of what they're doing on the streaming platform. They're rolling out the more adult-oriented kind of Star network globally as well. I think they gave more details of that recently. But yeah, so now you have Disney, the streaming. It's them and Netflix at the top of the streaming chain. There is not even number threes. Everyone else is going to be fighting for share at the bottom. And then what I love about Disney, here's a stock that, obviously took its lumps at certain points of 2020. I think got as low as 85 or somewhere in the high 80s. And now you see it's knocking on 200. Here's a company that survived on their streaming strategy while 2/3 of the business was literally on fire. The parks business, the film industry has been under attack. Cable with the lack of live sports, that was a big part of them. So I think Disney's a stock will continue to re-rate higher. It's getting a little bit stretched maybe up here, but if you do see a pullback, like something like Apple, like a 10-15% pullback, you want to be buying it. It's got great exposure, and they got a lot of exposure to the opening up of the world coming in the second half of this year. I mean, their numbers could really explode to the upside. The back half of this year.
Yeah, and for so many reasons, don't we all just want to go to Disney World?
Yeah, I don't want to go there quite yet. Yes, those millions who do.
Yeah. Well, and you have little ones, so you'll be going, I'm sure. Joel, I'm going to let you get back to trading. It's 1:45. Thank you so much for your time in the middle of the day. Appreciate it and all your thoughts. Yeah, that was great. Thank you.
All right.
See you soon. Okay, have a great rest of the day.